You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome, deep divers. Today we're jumping into a really crucial global market briefing. It's packed with insights, everything from central bank moves to, geopolitical shifts.
Absolutely.
Our mission for you is simple. We're going to sift through the latest on currencies, commodities, tariffs, global politics, all of it.
Yep.
The goal is to pull out the most important nuggets of knowledge, help you understand these complex forces shaping the world economy right now, and, well, why they actually matter.
Mm-hmm.
And this isn't just one headline. It's a comprehensive look, really, at the cross-currents hitting the markets.
Okay, let's unpack this.
And that comprehensive view is so important because what's fascinating here is just how interconnected all these factors are. They might seem separate, but they're not.
Right.
So we're going to explore the latest from the Federal Reserve, unpack their signals, what they mean.
Okay.
Then we'll look at how commodities are reacting, how they're absorbing all this. We'll also analyze the evolving trade policy landscape that's always shifting.
Totally. And of course, we have to talk about the geopolitical risks. They're persistent, always casting a shadow.
Okay, so let's kick things off then with the big one. The Federal Reserve's recent rate cut. Everyone was watching this. Headline decision, right?
Huge news.
What was the specific cut and how did the markets react, at least initially?
So Fed cut rates by 25 basis points. That brings the target range down to 4.00, 4.25%.
Okay, 25 points.
Yeah.
Yeah.
And the nuance here is really in their reasoning. They framed it as a risk management step, kind of trying to get ahead of potential economic problems down the road.
That'd be precautionary then.
Exactly. And Chair Powell was pretty clear. He stressed there was no need to move quickly on future adjustments. Policy will proceed meeting by meeting, a very data-dependent language.
Right, step by step.
And if we dig into their internal projections, the famous dot plot.
Ah, yes, the dots.
It showed, well, a more cautious path forward than maybe some people expected. You've got 9 out of 19 officials seeing maybe 2 more cuts in 2025.
Okay.
But then 2 see just 1 cut. And interestingly, 6 officials actually see no more cuts at all next year.
Wow, 6 see no more cuts. That shows some real division, doesn't it?
It really does. Highlights the internal debate happening within the Fed about where things are headed.
So with that kind of internal division, that sounds like a recipe for, well, market confusion. How did the financial world process that mixed message initially?
Precisely. I mean, markets first read the statement and the dots as pretty dovish, leaning towards easier money.
Right.
So many started pricing in a faster easing cycle. But
Yeah.
then came Chair Powell's press conference.
Ah, the presser. That often changes things.
It really did. The sentiment reversed quite significantly. Now, look, a December cut is still fully priced in by the markets.
Okay.
But that overall enthusiasm for a really accelerated easing cycle, that's definitely cooled off.
Got it. So if we connect this to the bigger picture, what about currencies? How does this play out in the FX world?
Yeah. The FX backdrop is described as finely balanced. That's a good phrase for it. Meaning there isn't one single dominant driver right now, which, leads to more volatility, quick shifts.
Makes sense.
Generally, a slower pace of U.S. cuts tends to help the dollar, especially against currencies from places with lower interest rates, the low yielders. But, and this is the other side of the coin, the Fed did acknowledge that the labor market is softening a bit.
Right. They mentioned labor risks.
Exactly. And that acknowledgement, that potential sign of a slowing economy, that puts something of a ceiling on how strong the dollar can get broadly. It's a real balancing act.
So definitely not a simple one-way street for the dollar. What signals should we be watching next then to get maybe a clearer idea of this labor risk calculus and other global policy moves?
Good question. Attention immediately pivots to other central banks now. We're looking for signals later today, actually, from the Bank of England, Norges Bank in Norway, and the South African Reserve Bank.
Yeah, a busy day for central banks.
It is. We're looking for insights into policy divergence. Are they following the Fed or going their own way? And domestically, in the U.S., the incoming jobless claims data will be crucial.
Ah, the weekly claims.
Yeah, they offer a quick read on that labor risk calculus the Fed is watching so closely. It's a major data point for them as they think about future moves.
So what does this all mean for you, listening in? How do these central bank decisions, particularly the Fed's cautious approach, ripple outwards, say, into the world of commodities?
Well, that's where you really see the interconnectedness we talked about. Commodities are like incredibly sensitive barometers. They absorb these exact same cross currents from central banks, from global events.
Right.
They basically translate all that macroeconomic sentiment into, actual price movements you can see.
Okay, so let's take gold first. Often seen as that safe haven asset, right?
Hmm.
How did gold react to the Fed's signals?
Gold did see a sharp pop right after the statement came out. That's pretty typical when there's perceived dovishness or more uncertainty.
Yeah, makes sense.
But that pop faded pretty quickly once Powell started speaking and the dollar firmed up.
Ah, okay, so a temporary jump.
Yeah. It flirted with some fresh highs briefly, but now it's kind of contained. What's insightful here, I think, is that gold couldn't hold those gains. It suggests that while, yes, policy uncertainty provides some underlying support, maybe geopolitical risk is a stronger, more persistent driver right now.
Interesting distinction.
And Powell's clear reluctance to just race towards neutral interest rates. That limits gold's immediate upside. It makes gold a unique barometer for global fear more than just immediate rate expectations.
Fascinating. Okay, what about energy markets? Oil, specifically. That affects pretty much everything.
Oil's in let's say, a rather subdued state right now. It had a choppy session midweek.
Right.
It's grappling with several conflicting forces pulling it in different directions. You've got the Fed outcome, which influences demand forecasts. You've got U.S. inventory data, which tells us about immediate supply levels. And then you have those persistent headlines about Russia-Ukraine infrastructure attacks, which always introduce supply disruption risks.
Always looming.
Exactly. Oil's complex drivers really highlight how vulnerable it is to both policy signals and, well, real-world instability. It's a direct proxy for global stability and economic activity.
And then there's copper, sometimes called Dr. Copper because people think it predicts economic health. What's its story right now?
Copper is similarly directionless. It reflects a broader caution, especially with more central bank decisions coming today.
So waiting and seeing.
Pretty much. It's caught in this push-pull. On one side, you have macro softness, signs of a potential global slowdown.
Okay.
On the other, you have specific supply stories, maybe disruptions in mining regions like South America or shifts in Chinese industrial demand.
Right, those micro factors.
Exactly. So copper's indecision really confirms this tug of war between, underlying industrial needs and these wider economic slowdown worries. It's not giving a clear signal of growth or contraction right now.
This raises an important question then. If these key commodities are collectively suggesting a market that's kind of grappling with uncertainty, not showing a clear direction, how should we interpret that for broader economic sentiment?
That's the million-dollar question, isn't it?
It really is. It seems these markets are just incredibly sensitive, reflecting that constant dance between monetary policy, geopolitics, supply, demand, all of it.
They absolutely are.
So how did these forces then ripple into that other really complex area? Tariffs and trade, that seems to be constantly shifting too.
That's a vital connection to make because tariffs, trade policies, they've become completely central to the policy tapestry. They're not isolated issues anymore.
Right.
They're deeply intertwined with everything else we've just been discussing, central banks, commodities, geopolitics. It all connects.
So focusing on that interconnectedness, what's the latest on the U.S.-China trade front? That relationship is always, shall we say, dynamic.
Dynamic is a good word. What's fascinating here is the sort of a nuanced dance going on. We are seeing what looks like an incremental sign of transactional de-escalation.
Oh, it was that.
Well, there are reports that Beijing dropped an antitrust probe into Google, and this happened during ongoing talks with Washington.
Interesting timing.
Very. It's seen as maybe a small positive signal, suggests a willingness to find some common ground on specific things. However, and this is a big however.
There's always a however with U.S.-China.
Right. Tech remains the core fault line between them. Those deep structural disagreements about intellectual property, market access, technology standards, they haven't gone away.
So a small step, but the big issues persist.
Precisely. It's transactional, not necessarily strategic alignment yet.
And meanwhile, domestically in the U.S., there's still plenty happening on the tech front too, isn't there, with TikTok?
Absolutely. That's still bubbling away, the ongoing congressional scrutiny of a potential TikTok deal. It's injecting a lot of uncertainty into the timeline, the structure, everything.
Yeah, seems far from resolved.
And it's not just about one app, right? It taps into these much deeper concerns around data security, digital sovereignty, the influence of foreign tech platforms. It's a microcosm of that broader tech fault line we mentioned.
We're also seeing reactions from other countries like Brazil to these global trade moves. What's President Lula saying?
Exactly. President Lula in Brazil has been quite outspoken. He's criticized new U.S. tariffs, calling them purely political.
Okay.
And he's warned they'll just lead to higher prices for American consumers. He's framing it as a domestic economic cost for the U.S.
Pointing the finger back.
Yes, but it's not just rhetoric. Domestically, Lula also just signed an order that exempts some data center equipment from federal taxes in Brazil.
Ah, so action at home, too.
Yeah, it shows a clear, deliberate domestic industrial strategy, trying to boost local growth, strengthen Brazil's own tech infrastructure.
Right.
The bigger picture here, and it's really important, is how tariff policy, supply chain resilience, and these domestic industrial strategies are all becoming increasingly intertwined.
It's all linked.
It is. Nations are trying to protect and promote their own industries while still navigating, or sometimes challenging, global trade rules. It's complex.
That's a crucial point. It's not just about putting duties on imports anymore. It feels much more like a strategic chess game.
It really is. We're seeing this fundamental shift where trade measures and fiscal offsets are now moving together.
What do you mean by fiscal offsets?
Well, take the U.S., for example. Officials are reportedly drawing up plans to use revenue generated from tariffs to support farmers.
Ah, okay. Using the tariff money to cushion the blow for certain groups.
Exactly. It's a direct reminder of this new integrated approach. It's a way to manage the domestic fallout from trade policy. Tariffs aren't just barriers anymore. They're also a potential revenue source to offset economic pain, weaving trade even deeper into national fiscal strategy.
Here's where it gets really interesting. When we think about how all these complex economic levers we've discussed, Fed moves, commodities, trade policies, how do they interact with the, let's face it, often unpredictable and volatile world of geopolitics?
Exactly. That's the next layer. Let's shift focus now to what are really the principal sources of headline risk impacting markets: the Middle East and Eastern Europe.
Always front and center, it seems.
They really are. These regions are in constant flux, and developments there have immediate, tangible consequences for the global economy.
Okay, starting with the Middle East. We have seen some diplomatic efforts lately. What's the current state of play there?
Well, what's fascinating here is that delicate balance you see in these regions, this push and pull between diplomatic efforts and ongoing conflict, and how that directly impacts markets.
Right.
So in the Middle East, we have seen some small but, notable steps to try and revive a diplomatic track. There were recent meetings in London.
Okay.
Israeli and U.S. envoys were there, apparently exploring the outlines of a comprehensive deal, looking at hostage release, a pathway to end the war. Qatari officials were also in London for separate related meetings.
So talks are happening at least.
They are. They might be slow, but these discussions suggest there's still a push to explore non-military options. And any hint of progress, even if it's incremental, can have a calming effect on markets. It reduces those immediate tail risks.
And there are other diplomatic currents too, right?
Yeah.
Involving Syria.
Yes, that's another thread. President Assad of Syria signaled that security talks with Israel could yield results within days. That sounds significant.
It does, but
he was very quick to caution that normalization is not on the table. He framed any progress as strictly tactical rather than political.
Ah, okay. Big difference.
Huge difference. It implies maybe willingness to de-escalate specific tensions, address practical security things, but without any broader shift in political recognition or long-term relationships.
So, for markets?
For markets, it suggests that while maybe immediate flashpoints could be managed, that deeper underlying regional instability, it's still very much there.
Meanwhile, over in Eastern Europe, the Russia-Ukraine situation obviously remains a massive concern, especially for energy markets.
Absolutely critical. President Zelensky recently reported, again, continued Russian strikes targeting energy and rail infrastructure.
Devastating.
And devastating with market consequences, too. These attacks aren't just tragedies. They keep an ever-present risk premium under oil prices.
Explain that risk premium again.
It's basically an extra buffer built into the price. Markets demand a higher price to compensate for the potential risk of supply disruptions caused by this ongoing instability.
Got it.
And these attacks also raise the prospect of more sanction discussions in Europe, which could further impact energy flows, trade, everything. It connects directly back to our oil discussion. These events fuel that price volatility.
And even closer to home for Europe, we're still seeing Brexit fallout impacting things like defense cooperation.
Indeed. On the UK-EU front, reports suggest talks about London participating in the EU Defence Fund have apparently stalled. The sticking point seems to be the fee question, how much the UK would pay.
Money talks.
Or stops the talking, in this case. But it serves as a really potent reminder that defense industrial cooperation cost sharing, these are still live policy issues for European security.
Right.
They impact budgets, strategic alignment, how efficiently Europe can manage its defense. It's a clear example of how political divorces, like Brexit, have these long, lingering, complex economic and security consequences.
It's so clear how these geopolitical threads just constantly weave back into the economic picture, whether it's that oil risk premium directly tied to infrastructure strikes or stalled diplomacy affecting trade. It really hammers home that global events aren't happening in isolation, are they?
Not at all. They're deeply interconnected with every single aspect of the market.
It's a lot to track.
It absolutely is. And I think the overarching theme, if you had to pick one from everything we've covered, is just the sheer interconnectedness of it all. The global market narrative right now is clearly one of, well, delicate balance and constant interplay between all these diverse forces. Understanding these crosscurrents isn't just about, staying informed for the sake of it.
It's more practical than that.
It's about being able to actually anticipate and make sense of the headlines that bombard us every single day.
So as you, our listener, observe these headlines unfolding in the coming days, what's maybe one practical lens you can use to help navigate these complex waters?
That's a great closing thought. As you see the headlines, maybe it's a new tariff announcement, maybe it's a shift in diplomatic talks somewhere, try to consider not just the immediate obvious impact.
Look deeper.
Yeah, look deeper. Ask yourself how it might be a subtle ripple from one of these other interconnected streams we've talked about. For instance, how might that risk management decision by the Fed echo in a commodity price like gold or oil? Or how might it even subtly influence a diplomatic negotiation happening halfway across the world? It's all connected. And understanding those links, even trying to spot them, helps you see the bigger picture much more clearly.
That's a really powerful thought to leave us with, a reminder to look for those hidden connections. Thank you for joining us on this deep dive today.
My pleasure.
Keep that curiosity alive, everyone, and remember to always think critically about the information you encounter daily. Until next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.